Vancouver's real estate market has a demand problem. Yes, that's right. It's just too good of a place to live.
The definitive guide on how to manage your credit. Product, penalty, price in that order. It's never been more important to get your mortgage right.
Welcome back. Today we're discussing the demand problem that Vancouver's real estate market seems to have because the amount of sales and the amount of demand continues to outstrip the number of new listings that are available in that market. And it is a really interesting time for the Vancouver market because there's a whole bunch of things going on that the media hasn't even talked about with respect to the September numbers. We have things happening in China, which include the Evergrande crisis and the real estate crisis that is unraveling there, which I can only imagine is going to do potentially one of two things. I'm not sure which, but it could potentially take money and move it out of Canada as money is taken back into the Chinese market, or it could cause even more money to evacuate the Chinese market and cause Vancouver's housing prices to go up even more as a result of people trying to get out of a market that is seemingly very dangerous for real estate investors right now. And on top of all that, we just have this scenario where Vancouver continues to be one of the best places in the world to live. We see many Canadians now finding their way to the western side of the country, trying to find nicer places to live, trying to live a nicer lifestyle, and that is having a continual impact on the Vancouver real estate market. But before we get into all the details and the headlines here, do me that favor, hit that subscribe button and that notification bell, and please hit that like button so more people like you can see this video. And don't forget, we're still giving away $5,000 when we hit 25,000 subscribers. And I sincerely hope that you who are watching right now are one of the winners. And oh, by the way, if you want to get my book, The Mortgage Millionaire, completely free, shameless self-plug, but real quick, because I think this is such a good time to get a book like this where you're preparing for higher interest rates and a market that could eventually correct. Well, this book, I'm giving it away completely for free right now. All you have to pay is shipping and handling. Just go to mortgagemillionaire.ca, and there are about probably by the time this video goes out, 100 to 150 copies left. You'll be able to see exactly how many are available when you hit that website, but go ahead, grab it for free. It's completely on me. All you have to do is get it from my door to your door. So let's get into the headlines here, talk about what's going on in the Vancouver real estate market. There's my buddy, Steve Saretsky. If you haven't checked out his YouTube channel, by all means, go ahead and do that. Really great Vancouver realtor, covers the Vancouver market very, very well. Lots of things going on in the market in Vancouver at the moment. Big thing here is we're hitting continually new record prices. We're seeing things like sales come down fairly significantly compared to last year, although they're still well above 10-year moving averages. And then what we're seeing is major declines in the number of listings that are available. So if we go and we take a look at the actual Vancouver data, what you can see is if you want to buy a detached home in the Vancouver area right now, on average, it's costing about $1.82 million. If you want to buy a townhouse, you can get one of those for just under $1 million. And if you want to buy an apartment, you're looking at around $738,000 to $750,000. Now, obviously, there are places and areas in the greater Vancouver area where you can get in for cheaper. There are also areas that are significantly more expensive. This is a very, very broad look at the market. But what you can see is that Vancouver is a very, very expensive place to live. It continues to be the most expensive place in Canada with an average price or a benchmark price of about $1.18 million. To put that in perspective, Toronto's is about $1.13, so they're about $50,000 more expensive than the Toronto market. And if you go ahead and take a look at what's happening there, we're obviously seeing less sales than we saw last year. However, that is not concerning. We expected some of those demand numbers to kind of teeter out. But what we didn't expect is we didn't expect to see supply numbers get lower. And in the last year, we've seen September over September in Vancouver area, the number of active listings go down by about 30%. What that means is that less people are selling. And when you have less people that are selling, even though you have less people that are buying as well, but when the balance shifts to there are significantly less sellers than there are buyers, well, then we find ourselves in those sellers markets again, where we see bidding wars and higher prices. So I suspect that going into the fall, into October, November, we're going to see a similar thing to what we saw last year. And we're going to see continually higher prices in a more competitive market, although maybe not as competitive as last year, but it isn't going to stop the continued increase in housing prices in the Vancouver area. If you go ahead and take a look at sales to active listings ratios, detached homes, about 25.5% are selling compared to the number that are listed. Townhomes, 53.1%. Condominiums, 36.7% for an average of 34.1%. And if we just go and take a look, here's the big number. MLS Home Price Index currently $1.1 million, $1.186 million, almost at 1.2. I suspect by the end of the year, we're going to see it at that $1.2 million number, which is absolutely huge. And, just a really interesting time for Vancouver real estate. So there's a couple of things that I want to make really clear and recommendations I want to make to Vancouver borrowers. First and foremost, in a market where housing prices are so high, there is a chance that they could turn and come the other way. And the big thing that we need to keep in mind there is that in the event that they do start to turn and they do start to go the other direction, the single biggest expense you will have as a homeowner if you decide to sell your property is a penalty on a 5-year fixed mortgage if you have one, especially if it's with a big bank. So in this sort of tumultuous market sort of time frame, what we want to make sure people are doing is they're getting the most amount of flexibility in their mortgage that they possibly can. So what that means is 5-year fix with a big bank. If you can avoid it at all costs, avoid it. If you absolutely need a 5-year fix, then I suggest you use what's called a monoline lender. So this is a lender that specializes in mortgages. They take A+ clients. They are, in fact, in most cases, taking better clients than what the banks take, but they have significantly lower penalties. The reason why they have significantly lower penalties and better rates in a lot of cases is because they can't skate on their marketing budgets and they can't skate on their brand names. They genuinely have to have a better product in order to survive. If they didn't, they wouldn't be around. So companies like MCAP, companies like First National, companies like CMLS, companies like RMG all tend to have really great products. Home Trust is another one run by one of my mentors, Yusuri Prasada. Absolutely great company there as well. But I highly recommend that if you need a 5-year fix, avoid getting it at a big bank, get it somewhere with more flexibility. By the way, in March 2020, when interest rates went from 2.7 down to 1.3%, there was one type of borrower that we absolutely could not help get a lower interest rate. That was the big bank 5-year fixed borrowers. The penalties were so high, they didn't have the flexibility to do it. Some people did. They probably don't realize that they probably lost a significant amount of money. But if you had a 5-year fixed mortgage with a monoline lender, you were able to refinance and get a lower rate. And the reason why is because those mortgages were significantly more flexible. Now, we obviously recommend variable rates right now because on a $500,000 mortgage, saves you between $2,500 and $3,500 a year. If you've got $1 million mortgage, which you might need if you're buying in Vancouver, double that $5,000 to basically $7,000 per year. And the key thing there, and sorry, it's not $7,000, it's $8,000. Nolan Matthias, the math major, thank you very much. The key thing there is if you're taking a variable rate and you're getting that lower interest rate, what we highly recommend, and this is all covered in my book, is that you set up a savings and investing plan where you take the difference between what a 5-year fixed rate would be and what your variable rate would be. You take that money and you put it aside into investments. So if there's a recession, if there's a job loss, if there's a turn in the market, you've got that money available there as a resource for the things that we're all afraid could happen right now, including higher inflation and higher interest rates. It's just about safety and it's about smart borrowing. And that's what we're trying to get across to people, is that a 5-year fix doesn't necessarily mean that that is the smartest option and it's protecting you, especially if you're spending $2,500 to $3,500 more for a mortgage per year that you could be setting aside for the eventual increases in interest rates that would actually have some harm to your finances. So, I highly recommend those variable rates. If you're not getting a variable rate, 5-year fixed from monoline lenders only. Don't let that banker convince you that you should be getting that at the big bank. Probably one of the worst things that you could do from a financial perspective, because 60% of Canadians don't make it at the end of their 5-year term, which means a lot of them are going to get saddled with really big penalties. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, hit that like button so more people like you can see this video. Don't forget about a race to 25,000 subscribers. You have to be subscribed to win. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it.